Welcome to McGraw-Hill Financial's June Loan Market Overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll discuss the choppy and largely negative conditions that have persisted in loan land since early May. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. This slide presents our standard disclaimer. The temperature here in the Northeast may be scorching, but in the loan market, conditions have cooled. Arrangers rolled out more new money deals in May than at any time since Lehman's bankruptcy. As a result, the market supply-demand dynamic has shifted in an issuer-friendly direction. In response, the S&P LSTA index eased in May. Though slight, the decline was the biggest in 11 months. During the first week of June, prices sagged further, pushing the index down another 14 basis points. Another consequence of softer technical conditions was rising clearing yields, which pushed up about 25 basis points in May. Default rates fell from their already low recent levels as fundamental conditions in the loan market improved. This chart shows why investors took their foot off the pedal in May. During the month, the available supply of institutional loans, shown here by the black bar, grew by about $5.5 billion, an amount equal to visible inflows, which is illustrated by the blue bar. The more relevant statistic, however, is one not depicted here. In May, accounts committed to $22 billion of loans that are slated to fund in June and July. That is enough new issue volume to soak up the prior 4 months of surplus inflows and leave investors feeling less anxious to get money to work. The effect of this technical shift on secondary prices is clear in the average price of LCD's flow name composite, which comprises the 15 largest, most liquid institutional loans in the market. In May, the composite traded off about 1%. It fell further over the first week of June to a 2.5-month low of 97.3. Likewise, in the new issue market, clearing yields pushed up. On average, they were higher by 25 basis points to 5.6%. The impact was most severe among lower-rated issuers, with strong B+, B1, and better-rated names little affected. As this suggests, investors re-emphasized credit quality over the last few weeks. The same was true in the secondary, where in May, CCC loans traded off 80 basis points compared to 17 basis point loss for single B paper. Double B names, by contrast, eked out a small gain in May. Looking ahead, most participants expect pressure on prices to continue in June, what with the pipeline of M&A-related loans now at a post-credit crunch high. By later in the summer, however, supply will likely ease, which may bring technicals back into balance. Switching gears, let's look at the loan market's fundamental condition. The best measure of this, of course, is the loan default rate, which pushed to a fresh post-2007 low of 0.91% in May. What's more, the annualized run rate for the first 5 months of 2011 was a curb-hugging 0.2%. To wrap up, some final points. As mentioned, the buildup in M&A-related loans will likely keep pressure on prices into June and July. Not to be lost in all this talk about heightened supply is the fact that inflows into the loan market remain strong. In this regard, the big story of May and early June was a revitalization of the CLO market. In fact, over the past 6 weeks, 5 collateral managers printed $2.3 billion of new vehicles, the most production in this space since before the credit crunch. What brought CLO issuance back to life is expanded deal leverage to about 10 times and shrinking AAA liability spreads to about 125 basis points over LIBOR from 175 basis points earlier in the year. Looking ahead, more managers have waded into the market to pitch new deals, and more expected in the fall. Finally, most managers expect default rates to remain low at least through 2012, assuming away, of course, a disruptive outside shock. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. As mentioned, you can also download this presentation at slideshare.net.